that goes on with Homebridge. So not only is he originating loans, he's somebody who is a real estate investor, 20 plus properties in 1 year. So he kind of understands our pain and what we go through. On top of that, we have another banker who happens to be Joe, and he happens to be the president of a bank that we've done business with for many, many, many years. And typically, we don't have him out. We don't have him because he's kind of in his space where he works. But I thought we wanted to have him on because he understands what we do in terms of the flips, the rentals, the refinances. And then we wanted to today, rather than just basing on how do you get a loan, what I want to find out from both of them is what do they see that is going on in the industry? More importantly, how do we today manage this whole mess? And then what do they see is the eventual outcome? And now, mind you, this is going to be changing as we go along throughout this whole process. But from their perspectives, because Juan is going to have a little bit different perspective, and then Joe is going to have a completely different perspective from kind of where they sit. So basically, I'm just going to do a quick introduction as to who's who and how these bankers fit in, because this is something a lot of times people don't understand. So typically what you have to think about from our end as far as real estate investors, and what we talk about Chicago REIA all the time, which is in terms of loans, there are three different spaces that exist for loans. One is your residential loans, which is your Fannie and the Freddie loans. So these are basically these are government loans backed by the federal government. These are quasi-private entities that make loans. So if you're looking to buy a house, if you're looking to refinance your personal home that you live in, or if you're looking to buy a residential property, up to 10 properties you can have financed with these loans. So when we talk about this, we're going to talk to kind of Juan, and Joe can jump in because they obviously do origination of some of these loans also. But Juan at Homebridge, we're going to kind of get his input on it, right? Then the second type of loan is a lot of times real estate investors may be familiar with, is what we call a commercial loan that you go to a hedge fund, right? So basically the loans that were done from Chicago Funding were backed by a hedge fund. The loans that were done from Lima, some of the other lenders, these are basically big asset managers that have a lot of money, and real estate happens to be one of the places where they deploy money. So that's sort of a loan. These are typically, lately what we have seen is about a 30-year fixed type of loans were out there. They were doing a lot of fix and flip loans. That market suddenly has disappeared. And it hasn't disappeared, it's temporarily necessarily on hold. We'll see what the outcome will be. And the third type of loans, which very few people are familiar with, but they're kind of the small banks. A lot of this, and when we're talking about small banks, for a bank to be a $100 million, $200 million bank, that's considered a small bank. But these are community banks that are in our communities, and they're doing a lot of the loans for a lot of people in America, right? And a lot of times what happens is most people don't even know that these banks still exist. They do. And they do a ton of loans. And they do loans for real estate, even a single family home, for a 2-flat, for a 4-flat, for a pizza shop you might open. And so Joe happens to be the president of one of those banks, and he's seen the industry from inside out. So we're going to get a perspective from somebody who is in this space, and then we're going to get a perspective from here. And why, you have to think about, why do we have Joe, and why is his perspective relevant? So if you think about what happened in 2008, what happened in 2009, what had happened was a lot of the lenders disappeared, right? There was no hedge fund that was lending at that time. A lot of the residential loans were very, very tough to get, even for rental properties. Fix and flip, nobody would do those loans. And at that time, that's when I started realizing that there's all these commercial small banks that are willing to do a lot of these loans for rental properties, for even in the right circumstances, fix and flips. They were, in fact, even depending on what year that was, some of them were doing new construction loans at that time, right? And a lot of these relationships are, these banks are based on relationships, so relationship-based lending, and a lot of times they're very, very flexible. So I want to kind of jump right into it. Let's start with Joe. So Joe, from your perspective, and Joe, can you say hi for a second? And Juan, just confirm for me that you can hear Joe.
Hello, Andrew.
Yeah, we can hear Joe.
Okay, all right, great. So, so Joe, let's just kind of jump right into it. A little bit of background, kind of where you come from in terms of the banking sector, so people have a little bit of reference point for you.
Sure, Andrew. Thank you for having me, by the way. I appreciate you taking the time to bring this all together this evening. I've been in banking for 37 years, and as Andrew indicated, I've spent the last 5 years as president and CEO of a community bank in the southwest suburbs of the Chicago area. So I've spent nearly 4 decades making my way through the community banking space in Chicago. I actually met Andrew in 2009, I believe it was, or 2010, as we were coming out of the Great Recession and as he was starting to build his real estate portfolio. And just as he described, community banks sometimes have some flexibility to look at not only the loan itself, but the borrower and try and find ways to round corners, sharpen edges, and make things fit that wouldn't traditionally fit in a secondary market type of a scenario.
So a lot of times, a lot of people, even when I came to you, right, at the time, I had gone and called a lot of banks. Initially, obviously, I started with Chase and, Bank One or whatever the big banks were at that time. They all turned me down. And I took it as a personal rejection because I'm like, oh, I'm just not good enough. I'm too short or I'm too this or that. And that happens to a lot of people. And it just happened to be after calling 20 or 30 banks, somebody referred me to another banker, and somehow he referred me over to you guys, right? And a lot of people aren't even aware that there's tons and tons of these small banks that if you know who to go talk to, there are a lot of different types of loans that are available if you really know which door to knock on and if you have the right set of circumstances. Why do you think that is that a lot of people are unaware of this?
Well, again, I think one of the biggest challenges is that community banks and the type of lending that we're talking about doing today, we actually portfolio the loan. So that means we keep it on our bank balance sheet as an earning asset. And one of the inhibitors that creates for us is it doesn't allow us to lock in a long-term interest rate. So many times when people are thinking they want to take out a mortgage, especially where interest rates have been over the last 10 years or so, they want long-term fixed financing, which is absolutely a right thing to do if you can get long-term low rates and you can fix it for an extended period of time. And as you indicated, there's some limitations in the secondary market, based on the number of loans and the types of loans that can be done. Where we fill in is where we can help get people started. Some things too that maybe aren't done on the secondary market are properties that are in trust or maybe in LLCs and other things that we can step in and do those types of loans. We do offer an extended amortization up to a 25-year. Our particular bank will offer up to a 25-year amortization. But like I said, one of the inhibitors that sometimes comes into play is that rate is only fixed for up to about a 5-year period.
5-year balloon. And it's actually funny, Joe, because you've heard us talk about 257. You follow kind of some of the RIA things that we've done. You've seen the progress, right?
Yes.
It actually came from there, the whole idea of 2 years, 5 houses, try to get them paid down in 7 years or so that these balloons is what I was afraid of in 2011 when we started really 10, 11, when we started buying rental properties, that, oh my God, what happens in 2015, 2016 if the rates jump and they jump to a higher level, what would happen? That's really where that whole idea originated from. So it's we've come a full circle. So let's switch over to Juan. Juan, really quick, brief history on where you come from so that people have a little bit of background who we're talking to.
Right. So I am a residential mortgage lender. I've been a loan officer for around 25 years or so, longer than I care to remember. So I mostly focus on the loans that are going to be what we call agency loans. Fannie Mae, Freddie Mac, FHA, VA, USDA. Loans that get originated by a mortgage banker like myself or a mortgage broker, Eventually, these loans all make it to the agencies, again, Fannie, Freddie, FHA. They get packaged and basically sold to Wall Street. So what keeps liquidity in our marketplace is that what keeps the money moving, right? I'm going to try to use simple terms because sometimes I get ahead of myself, but what keeps the money moving is that we do very similar loans to each other. All of the loans follow agency guidelines, and we're able to sell those loans to the secondary market, which is Wall Street, which is basically all of the money managers buy these mortgages, put them into the massive portfolios, which are in your 401ks or the managed accounts. And when they buy the loans, that's what we're able to basically get our money back and go lend it again.
Okay. So you're more on the basically agency side of things. You're doing, most people have heard of Fannie, Freddie, to keep it simple. Those are the kind of loans that you're doing typically. I've always said
Correct.
These loans are pain in the ass to get, right? They want to know where your forefathers came from and then some, but yet they have 30-year and they tend to have very, very good rates. But just understand, they will give you an examination like no tomorrow, including your blood type. Now, probably if you're corona positive or negative, I'm just, I'm kidding, but you guys get my point. These are loans that they're a pain in the ass loans. But if you can get them, like Joe said, nice fixed 30-year loans, and a lot of people have that. So another thing, I want you to just kind of briefly talk about your investments, because that way it'll give people a background of because
Sure.
This is a good mix between you and Joe.
Right. So, over the last, at this point, over the last 2 years or so, I have personally been able to use the 257 strategy. I have been able to buy, fix, rent, and refinance. I've been able to acquire 20 properties and build a very healthy cash flow portfolio. We were doing it with a combination of, personally, I was doing it with a combination of commercial loans, private money lenders, and again, our takeout strategy had really been the commercial lenders, which unfortunately at this point have dried up practically overnight. They dried up.
Okay, so he's talking about, guys, you kind of look at this, the chart here, he's talking about this particular space, right? This space up here exists still, which is the residential loans, which he does. This space where we have Joe, hence we have Joe on the line, down here, which is the community banks, they exist still. So let's just talk about it, because a lot of times people look at the real estate market in a very superficial way. What they think about is, oh my God, Andrew, something like this happened. What do you think is going to happen? Is the market going to crash? Are people going to lose homes? What happened? And my belief has been this: if you've made financially poor decisions for a long period of time, guess what? Something like this can take a terrible, terrible toll on what happens to people. A lot of times, when even people who have saved money, who have been good, whenever something terrible like this can happen, it can be devastating, because somebody loses their job. They were doing fine. Suddenly, it can put them in a tailspin, right? So everybody understands that. But today, we want to talk a little bit more depth about this, which is that tomorrow, if you want to do a flip, what do you do? Who do you go to besides private money? Where do you go to? You can't right now, early. You can't go to hedge funds, right? Though they're kind of sitting on the sidelines for right now. If you want to refinance the property and you were going to go commercially for a 30-year fixed loan, suddenly these guys have put the whole thing on hold. So what do you do? What are the problems that come up, and how do you deal with it? If you saw the last webinar that we had done, what we had said was a lot of banks today are offering you basically a forbearance on your residential loan, on some of the commercial hedge fund kind of products. And what we had said was people like Joe that we have long-term relationships with, we want to keep those. See, we want to keep doing business with small community banks, people, and so we want to keep our financial foundation very, very solid. So if I have 8 properties here that are properties on the residential side, I have, let's say, 50 loans with hedge funds, and then I have 35, 40 loans with 3 or 4 banks like Joe's, we want to reserve this relationship because as we work through these times, what's going to happen is that we want more and more lending. We want to grow because of this, because as the economy has interesting kind of phase that we enter, it will create an opportunity on the other side. So from your end, Joe, what do you see? What do you see in today's landscape as a banker?
Well, today it's early. I mean,
Yep.
we're still seeing the impact of the shelter in place, the businesses that have I hope they're temporarily shuttered, and we haven't even seen the impact of the $2+ trillion stimulus that had been passed by Congress and signed by the president. But we are seeing some of our commercial real estate clients that have been impacted, that had tenants that were restaurants, beauty salons, other places that were considered non-essential, so they have absolutely no revenue to support not only their staff but pay their rent. We're starting to see a little bit of inquiries from our multifamily clientels that have units, 8 units, 16 units, 32 units, and they've done their polling of their tenants, and now that we're past the first of the month and have found out that a certain percentage of those tenants are no longer gainfully employed. So they're trying to show empathy, hoping that this will be a temporary deal, and they're asking questions. It'll be interesting to see. I'm going to play an optimistic card here, that this is different than 08 and 09 because it's more like a natural disaster where, and I can point to ourselves because I was part of this club, not necessarily a contributor, but I was part of the club, that the 08, 09 we did to ourselves. It was a process that the financial institutions, Wall Street, and everybody got into that created a house of cards that collapsed, where this current situation, I think, equates more to a natural disaster, something that we haven't seen on this scale in anyone's lifetime. So if anybody actually tells you they know it's going to happen, you know that they don't know, because nobody truly knows.
Sure.
But I haven't seen the panic come across yet, but I'm starting to see people asking questions. And Andrew, you and I have had this conversation many, many times. When you're dealing with bankers, especially at the community bank level, conversation is key. Communication is key. The more you ask questions, the more opportunities that can be created, whether they're positive or to help eliminate the negative.
Right.
And so that you never know what tools are available until you start asking questions. And then we can find different ways, like I said, to round a corner or sharpen an edge to keep things moving, knowing that tomorrow takes us a day closer to whatever the resolution will be.
Right. So you feel we're in a freeze. I mean, to me, that's really, until the freeze is over, nobody really knows, right? Everybody obviously, everything that's on the internet, on social media is all fact, right? All these, the pundits and the gurus, all the predictors, they come out of the damn woodworks, which pisses me off. But nobody knows yet. I mean, we don't know good, bad, indifferent. Clearly, nobody likes this. It's not a positive thing for anybody, but we're in it as the world. I mean, we're in it as the human race, not just in the United States. It is what it is, and we just have to deal with it, is where you stand for right now, correct?
Absolutely. And the one thing I'll add to that is that having been through this a decade ago in the 08, 09, kind of the Great Recession type of thing, the regulatory bodies that oversee the banking industry are treating this very differently. In 09 and 10, there was a lot of pressure to deal with troubled assets, to find issues and to resolve them quickly. They're almost taking a 180-degree approach to this, basically saying that we want you to be collaborative. We want you to work with borrowers. We want you to continue to do what you're doing in the effort of, looking forward rather than trying to create an immediate resolution. We've gotten all kinds of guidance, different things, different approaches we can take, that if we'd have taken that approach 10 years ago, it would have had a totally different regulatory consequence. So I see a lot of positive from what people learned from the last time that said, wow, if we try and address it real early and push everybody really hard, all we were doing was adding insult to injury. Where now it's more, like I said, the communicative, collaborative, if I dare even say, borderline compassionate approach to understanding what's going on, knowing, and again, knowing is in quotation marks, that this should be a short-lived cycle, at least of the virus, and then trying not to have that compound into a devastating economic cycle.
But so from your end, you see positive things, at least from the Fed's guidance that you guys are getting so far.
Yes, sir. Yeah, I would agree that, again, comparing that to what happened in 09 and 10, a very different approach.
Okay, got it. So Juan, from your end, as an investor, as a residential, broker, and the manager for Homebridge in the local area, what are you hearing?
Well, I think what Joe is saying is very much on point. I would say that this is, what we're going through right now is I would say much more similar to what happened, post 9/11. That there's an initial impact, an initial shock to what happened, at 9/11, and hopefully we're going to be able to work through that in a reasonably short period of time. We're not expecting this to be, a long drawn out, situation like a recession. So hopefully, this is more of a short-lived impact. What we're seeing, from our end, we're definitely feeling some challenges when the Fed is coming in and they're making quick adjustments. They're making very quick adjustments in the mortgage world. That what we really come to learn, that we live in a very delicate ecosystem, which is the mortgage and the secondary market. And what's happened on a very very large scale is as the stock market was in a very quick free fall. The stock market dropped 30% in a very short period of time. Normally, you would have seen that money enter the bond market. Bond market goes up, interest rates come down, and there's a very delicate ecosystem. When the Fed came in and started buying mortgage-backed securities, what ended up happening is it really started forcing what we call a lot of margin calls. So the mortgage bankers who were basically protecting their interest rates as interest rates move up and down, we hedge those interest rates. And we hedge it against, rates dropping.
Hold on.
And long.
Hold on. Slow down, man. You went too far ahead and you skipped
too far,
a step.
too fast.
Yeah, people are not going to understand hedging the bet. So explain this in terms of an interest lock, right? Explain a lock, what happens, because people will understand that this is too far and too advanced. So explain that.
So what ends up happening when somebody comes to us as a Fannie Mae lender and they says, "Hey, I want to lock in my interest rate. You're offering a rate today at 4%," and we say, "Okay, great. We're gonna guarantee that 4% interest rate for 30 days, 45 days, 60 days." Now, it's not like we don't really go to Joe's bank and say, "Hey, you know what? We need a couple $100,000 or 4%." What ends up happening is we're committing that amount of money. So we as a company are committing a couple $100,000, and we promise to give you that rate in 30 days. And we're basically we're almost purchasing insurance policies, right? That when we hedge on the secondary market, we're basically insuring ourselves against movements up or down. And the money that we're actually lending today are the reservations that we took 30 days ago. So they're basically, because what happens is if we go out and we promise an interest rate at 4%, and the rates have moved to 4.5% when we're actually lending the money, we physically have to pay to buy that rate down to 4%. When the interest rates have dropped to 3.5%, so let's just say we promised a rate at 4%, and now we can borrow the money at 3%. we can make up a little bit of that money that we lost by having to buy the rate down. So there's this little roller coaster up and down that happens every day. And we have very smart people in our secondary lock department that know how to deal with this. And really, the money that you make when the rates go down is really the close to the money that you lose when rates go up, and it's a very delicate balance, but somehow it manages to work. So what ended up happening when the interest rate markets were, the stock market's in a free fall, the bond market's in a free fall, and now everybody hears that the rates went to zero. It's just a lot of noise in the market. And then what ended up taking place, the real reality is that the Federal Reserve came in and started buying mortgage-backed securities. Well, these are the same securities that the mortgage bankers like myself were buying. We're basically, using those mortgage-backed securities to hedge against the interest rate locks that we're promising. And by the Fed coming in to buy those mortgage-backed securities, it prevented the mortgage bankers to make up for the losses, right? So there was this imbalance in the universe, right? We're like Jedi Knights, and all of a sudden there's an imbalance in the Force, right? Let the Force be with you. So what happened was all of a sudden, because the bond market, the mortgage-backed securities didn't go down in a natural setting, all of a sudden it forced lenders to take real losses, and by taking those real losses, it forces lenders the credit lines that we use, our lines of credit, if you would, those lines of credit, the bankers started saying, hey, wait a minute, you don't have enough collateral because you've lost money, and now we get margin calls. So all of a sudden, our lenders are calling us up and say, hey, why don't you put another, $10 million in the bank because it looks like you're a little short this week, right? And not a big deal if you happen to be sitting on an extra 10, 15, $20 million. But for those that don't or that can't, all of a sudden mortgage lenders stop lending money, right? You start hearing that residential lenders are no longer accepting locks. You start hearing that, hey, wait a minute, interest rates went overnight. We managed to lock some people in as low as like 2 5/8, 2.625. And then all of a sudden overnight, we're talking about interest rates at 4.5. Well, why is that? Because there was too many people coming to the lenders, too many people trying to lock loans, and there's not enough capital that's available because we all became over capacity, right? So how do banks or how do lenders slow down the volume of loans? Well, they raise the interest rates. The higher the interest rates, the less people that want to refinance and say, okay, well, we went from refinancing loans, investor loans, we were probably down all the way in the, close to 4% range. Well, all of a sudden an investor loan went to 6, 6.5, 7, and you saw the commercial lenders went from the lowest commercial rate that I had seen on my loans were probably about 5.625. And then all of a sudden the commercial lender said, hey, you know what? We can no longer do 5.625, but we're at, 7.5. Oh, okay, great. I'll take that 7.5. And then it went to, hey, you know what? Now it's 8.5. And then the next day they're saying, we're no longer accepting locks. And then they said, well, you know what? We were kind of kidding. The loans that we had said we could do, we're just not going to do them anymore because there's no more money available. The hedge funds, basically the hedge funds pulled back out, which is, where you see that the commercial lenders have all but stopped lending is because they don't have the hedge funds available. Rich people with lots of money are, they kind of get attached to it and they say, well, we'd rather not lose that money, right? So yeah. The long story is that it's a very delicate ecosystem that we live in. And, once the Fed realized what was happening is, again, that every time they were stepping in to buy mortgage-backed securities, they were virtually putting, mortgage bankers out of business because we were losing tens of millions of dollars overnight. So they have stopped that practice, which is helping out. The next wave of crisis that we're dealing with is that there's certain rules and regulations that we have to follow in regards to, again, the laws or the rules of mortgage forbearance were not created for a time when hundreds of thousands of mortgages were going to go into forbearance at the same time. So there's huge servicing issues that we're dealing with on the backside of the business that, again, it looks like, some big dramatic changes are going to hopefully be taking place in the way that the, not only Fannie Mae loans are serviced, but more importantly, right now, the FHA loans. And you say, well, what do FHA loans really have to do with investors? Because that's not what investors are using. Well, the problem is again, the Fannie Mae loans that we use to use as takeout loans for the investment loans, these are the same lenders that are doing FHA loans. So if the FHA market puts me out of business, well, that's well and fine. It doesn't impact the investor, but it does because we're the same guys that are doing those Fannie Mae investor loans, right? So we're kind of tangled all in one. Right now, it looks like the servicing crisis. Hopefully, we're getting through that servicing crisis. And my company happens to be in very good shape with that. We had sometimes the luck or the great fortune that we had sold off about 75% of our servicing portfolio about a year ago. So we're running rather efficient. Some of the big major servicers out there, they have some severe problems going on. Hopefully, they're going to be able to resolve those issues because nobody wants to see major players fall. If you go back to the 2008, 2009, we used to have something we called the implodometer. It's like what companies failed today, what banks failed, what mortgage companies failed, and we're really hoping that that's not what this goes into, and that this is just a temporary shock of the market, and we're going to dig our way back out of there quickly.
Got it. Joe, you've heard this talk quite a number of times. These are the types of issues you guys are going through, even with these small banks. Is that correct?
Yes. We actually are one of the purchasers of the mortgage-backed securities that he just very eloquently explained how they work. So we're on the back end of that.
Okay. So that's more technical. So let's talk about the practicality of it today, right? Assuming, because nobody knows, we're still too much in the middle of it. We're just almost, it's like a kind of everything is frozen in place, and people are like, hey, let's just get everybody's health okay, get past this craziness, and then we can start figuring out how to try to go back and start restoring things in the norm. Because if you don't have health, your wealth really doesn't make any damn difference, right? You can have bajillions of dollars, but if you don't have the health, and that's really, something that is a thing that we're dealing with. But assuming that 45 days or 30 days, whatever that amount of time is, that we go back to start eventually getting back to normal, knowing what you know today, right? As a person who's supposed to be running a bank, how would you look at this whole thing?
Well, right now we're taking the approach that you just described. That this and I think the 9/11 scenario that was described earlier is another good example of how we've lived through something similar to this before, just not necessarily with the virus type mentality. That it is going to be short-lived. Now, if I was to go tell my wife this is short-lived because she's been she works in the school district, and she's been home now for a month, and it's very difficult, being basically, locked in your house for an extended period of time. But let's push it out 45, 60 days. It is a survivable time, as you just described. The forbearances and the other things that are being made available will allow people to keep some sense of stability. And another big difference from a macroeconomic perspective is that the fiscal stimulus is coming immediately, where last time the fiscal stimulus came almost too late. As Juan just described.
Before you move past that, can you describe, because this is a conversation we were having, and I want people to understand that last time, whenever the stimulus came, right, a lot of times people are like, well, the big banks got the help and the small banks didn't get. There's a lot of BS that goes around, and people make these generalized statements without understanding kind of the bigger picture, without understanding the facts. They just repeat. But what happened with a lot of the smaller banks? Why were you guys not offered? Did you guys just say, no, I'm too good for it? What the hell happened?
Well, no, it went top down last time.
Okay.
If you get a chance to watch the movies, The Big Short or Too Big to Fail, when they pulled everybody into New York, I didn't get that call.
Okay.
Right? It was the Jamie Dimons and the Wells Fargos and the much larger banks that came in, and they said we have to stabilize the biggest parts of this first, because the whole concept of too big to fail started to come into play. And then the idea that obviously smaller banks, that if they were well capitalized, did prudent lending, and really stayed true to the rivers and the streams they knew, they survived it. Others that maybe got out didn't make it happen. But last time they went top down. This time the stimulus is kind of coming at all angles, and it's coming at all levels. I know that if you're suffering, it doesn't seem like there's ever enough, but the idea that a good portion of the American citizenship will get stimulus checks in the neighborhood of $1,200. The idea that if you get unemployment, there's extra monies put into the unemployment for at least through a short period of time to help with that. One of the things that I've been working on diligently over the last week, 10 days, and now finally they've let some of the water go over the dam, is the Paycheck Protection Program that's being administered by the SBA, putting money right into small businesses. Now, granted, there will be some of the bigger bailouts, Boeing, the airlines, the hospitality industry, but the stimulus coming at the front end of this makes a big, big difference from a macroeconomic perspective. If you remember, and it wasn't that long ago, but it's funny how time allows us to edit things. The banks were failing, just as Juan described, that implode factor, Wachovia, IndyMac, Washington Mutual. I could go on and on and on. They had failed before we finally got a stimulus package. Where this time it's on the front end saying, hey, we realize there's going to be a problem here. Let's take some medicine. Let's put some Band-Aids out there. Let's keep the things moving so that when the 60, 90-day period of whatever the full virus runs and the curve is flattened, and I'm not going to pretend to be a doctor or some type of viral person, but the idea is that if that curve gets flattened and things can kind of get back to whatever this new sense of normal is, that there'll be a lot of gasoline on the floor so that when things start to ignite, it'll roar a little bit rather than this whole trickle-down kind of concept.
Right. And I think that is huge, because a lot of times the normal person may not see it, may not understand it, but it does make a difference as how quickly, and I think because it's a world pandemic, and because with 2007 and 8 in the background, everybody remembers that. It's fresh enough for people to remember that, and so now they want to move ahead of it to kind of prevent as much casualty as humanly possible, the financial devastation that we saw. Correct?
Yes, and to not only, but to shorten that cycle as well.
Sure.
Because it was an extended cycle, probably 2008 to almost into the end of 2011 before we really, truly started to see the economy come out of it.
Got it. So a little bit, I know, because I started reaching out to you about 2.5, 3 weeks ago, as I'm like, hey man, I just wanted to run some ideas, bounce some thoughts by you to see how we're thinking. Are you thinking the same way? And nobody has, mind you, at this point. Some of the points we may say may be moot 3-4 weeks from now, right? Or they may be very, very valid because it's a developing situation as we speak. But in terms of the three types of different things that have come out, one is everybody kind of heard about it. I call it the $10,000 loan, right? The second one is the paycheck protection, and the third one is a loan for if you're a small business, blah blah blah. That can be backed with some sort of a real estate. Can you talk about that a little bit? Break that down a little bit.
I'll try and be brief because they do get a little bit complicated. But the first one you said was a $10,000 emergency loan, and that was those are applied directly through the SBA, and it's pretty much if you apply and you show that you had economic injury from the coronavirus, the COVID-19 situation, they were trying to fulfill those as quickly as possible. So those are in process now. I'm going to skip the second one and go right to the economic injury disaster loans. Again, those are for businesses, and real estate businesses can apply for these. So if you are a real estate LLC, you are eligible for this type of lending, but you apply directly with the SBA. The amount of economic injury that you can show, and you're going to have to show that you did have economic negative impact, then you can get a loan to make that up, and it's an extended period of time, up to a 30-year amortization. The interest rate is fixed at 3.75, and your first payment is not due from 1 year after when you take the loan out. So another really robust program, low interest rate, extended amortization, first payment deferred, and then there's no prepayment on it. So that if you did find yourself coming back around and you had your cash flow back and you wanted to get rid of the SBA loan, you could do that, and they're fine. They'll take their money back and you go away. The middle one that you talked about, the Paycheck Protection Program, is one that if all small businesses are eligible, including not-for-profits, but you have to have payroll. That's kind of the key, because what they're doing is they're saying, you to tell us what your average payroll was on a monthly basis for the past 12 months. We will make you a loan at 2.5 times that average monthly payroll. If you use that money to keep your payroll in place, keep paying people, and you pay your rent, and you pay your utilities, and you prove that that's what the money was used for, the SBA is stating that that money will be forgivable, and what was a loan becomes a grant and is now paid off, and you owe nothing.
It's interesting, and this is just, I have very little understanding of finances, but it's interesting that they have actually, if it is used and if it does what is intended to, it's actually pretty well thought out, man, because what they're saying is, hey, if you're an employer, we don't want millions and millions of people to lose their jobs. So we're going to hold you over by making a small portion of it. The $10,000, and this is where my confusion was also. Some people say it's a grant. Some people say it's a loan. How does that first part work?
It is a grant. The only way that you would turn it into a loan is if, for whatever reason, you were found to not use it for the purpose that you stated. But that is almost like the consumer stimulus check. It was an idea that says, hey, we don't want you to close tomorrow. Here's $10,000. Keep the lights on.
Got it. And so basically what they're trying is, even for small businesses, right? Typically we hear this all the time, that small businesses don't get the help. That's where the help is really needed. It's not upside, top, that trickle down. This is kind of from the grassroots of it. But at least at the face of it, the intent of it is truly to keep Americans employed, to keep as much economy stable, hold things over in the short term as humanly possible, right?
Yes, I would agree with that. Absolutely.
Okay, got it. So from your end, coming back to your particular, kind of the space that you exist in with these small banks and all that sort of thing, that are you guys still willing to do loans if investors come to you with the right type of set of circumstances?
Well, it's kind of interesting because we knew immediately when the hedge fund stopped.
Right.
Because then the phone started ringing. Because obviously you had the secondary market option, you had the hedge fund or your commercial option, and then you had the community bank. Well, when you pulled one chair out of that, some people were in process. They were at the point where they were 80% of the way through. They had appraisals done and everything else, and then they stepped away from the table. Our phones started ringing. So we've seen a lot of activity from that particular event occurring. We're continuing to lend. That's what we do. Obviously, we understand, just as was being described earlier as well, that the risk portion of this has kind of gone up a little bit due to the uncertainty. You're seeing 3 million one week with first-time unemployment, 6 million the next week for first-time unemployment. Who knows what it's going to be, this coming week for this week's report. So that creates a little bit of, kind of got to keep an eye on things. But yet we also are, at least currently, under the mindset that this too shall pass. This isn't a 3-4 year cycle. And again, I don't want to beat the drum, and this absolutely is not a political statement, but the power of the stimulus entering the problem sooner than later makes a big, huge difference.
I mean, this is all, we're talking about it from a real estate finance standpoint. We're not getting into the politics of it at all, right? We're talking
right.
about
No, absolutely.
what we see today, right? And again, if things change, our tune will change because we don't know, right? We just have to deal with it. But clearly, I happen to have a belief, doesn't matter really what they do, right? People are going to be devastated. It is unfortunate, but that is 100% clear. And I feel, you're not saying this, but I'm saying this, I feel the entire world, not just America, the entire world is going to try to print their way out of this, right? They're going to print money like we have never seen before. What do you say?
I absolutely agree. I think that's exactly what's happening right now, that you see how assertive governments are being to address this, both not only on finding the resources to address the current medical challenges that are out there, buying ventilators, masks, building temporary hospitals like they did at McCormick Place here in Chicago and things such as that. It's amazing where all of a sudden resources can come from, but then also trying to address the potential economic impact of that means that the printing presses are going to be running. And I love the comment that the Fed chair made recently. He goes, and we used to talk about, well, we just have to print more. He goes, we don't even have to print more anymore. It's all electronic.
Right.
So he says all we have to do is push a couple buttons.
Right.
And there's more.
And I think a lot of times, people get hung up on what is the GDP, what is the, all this stuff, what is the debt. We've never seen, as far as I'm concerned, and this is, I always tend to compare what I see happening in India to here, because obviously my background happens to be from India, right? But I truly, truly feel in today's world where we live, doesn't really matter where you are, we're all in a place where none of us want to go backwards. Nobody in America is suddenly going to cut down their lifestyle, right? And nobody around the world is going to say, no, I'm going to sacrifice the next 5 years and I will do without. That's just not what I see happening. If anything, we want things quicker and easier, and we want to fix things, and we're going to kick the can down the road. As far as I feel that way. What about you?
Well, I think obviously as a society we've done a lot of that, and I don't want to turn this into, because I do teach economics at a collegiate level as well. But we got to remember, we entered this current pandemic with a $22 trillion deficit. Yeah. So that's somewhere down the road that's going to have to be addressed one way or the other. We're going to be adding to it, but to your point, you have to get through tomorrow to get to next week to get to next year, and that's how we have to take it. And Andrew, I'll applaud you here with your group that you put together here, that you had the foresight when still many people were worried about what's going on to find the opportunity in the chaos. Right. And you got in early. You understood what you were looking for. You were choosy. You knew what you wanted, and you had a plan. And that's what we look for at the community bank level when we're looking for a borrower. Many people come in and say, well, I've got the right collateral. It's going to cash flow. But part of it is, do you know what you're doing? It's so if you know what you're doing, that now could turn, this chaos could turn into an opportunity.
Yeah, right. And a lot of times this is kind of funny. Even before I had you on, I'm like, Joe, man, I'm going to invite you on because you kind of follow all the things we do. But I'm like, we're not going to turn you loose to the mayhem. the entire thing, even within mastery, right? When we send you people, we tend to be very choosy, right? And we'll call you, I'm like, hey, Joe, listen, this is this guy's situation. He's good credit. He has his ducks in a row. The property will qualify, because these are relationships that are built. I mean, think about it. If you had a banker, people who work with you, that do good things with you, that help you build, do you want to refer them people that are basically going to be bonkers, that are going to be crazy? No, of course not. And these are relationships that are built, which is very, very different than when you go to a regular residential lender, than when you go to a hedge fund. They're packaging it, they're selling it, it's gone, and it's not there. Here, these are long-term relationships, and we want the small banks and all these people to do well, because guess what? At not only, and even when a lot of times people, Joe, were like, well, why would you keep going back to Joe for some loans? I'm like, listen, you should never put all your eggs in one basket. That would be stupid, right? You want to have some 30-year fixed loans, you want to have some 30-year fixed with hedge funds, and then we have a bunch of loans with you guys. And that way you spread your risk around. So in case the interest rates jump, in case something happens, guess what? All this hard work that you have done, and today that's our point from our end, is that it's not just about the chaos. We all have to deal with it on a personal level, social distancing and all that stuff. But at times like this, what becomes important is to keep a level head and keep thinking of how do we come out of this and what is next. How do we, there's one thing that's for sure. At some point in life, we all are going to be dead. And the other thing is that there's always going to be change. If you're not willing to do that, I think we as a society are going to be in big trouble. Having said that, guys, any final thoughts? One, that you may have, some of the stuff you were talking about was rather technical, but I did want you to touch on that. But any final thoughts from your end? What do you see?
You know, I think right now what we're going to see in the very short term is the people. You know, some of the members, some of the mastery members have gotten caught off guard a little bit, right? They were following a path of commercial loans, and that became a very easy path, myself included in that, right? So a lot of us were using these commercial loans, and we became very comfortable with them. For the members who can qualify, right, that they do have the right documentation, the tax returns, pay stubs, bank statements, self-employed, whatever. Right now, that residential loan becomes very relevant, and we need to get as many of those loans done as possible right now, because that's the solution to we need to satisfy the private lenders. You know, they're expecting to get their money back as quick as possible, and I think the path of least resistance is for the people who can qualify with residential loans. We need to use them. Whatever ridiculous things we ask for. That's just how it is, right? For some other people, and again, I personally, I'm gonna be looking to connect with Joe, because I might say, hey, listen, I have these 4 or 5 properties that I was gonna go commercial, and I want to package them together, and can I do a blanket mortgage on multiple properties? I think that might be a solution for those that we're building quickly, right? So I think, personally, is looking at what, again, there's how many members that are out there that got caught in the middle of how many different projects, which is only you know what that number looks like, Andrew. And we need to, take some of those people through residential mortgages, possibly some of those people through the community banks. And, one of the things I think Joe mentioned is that communication is key. If there's any of these members that took out private loans through the RIA or private loans through family members, you have to communicate with your lenders and say, here's where things are. I think we're going to see, things open up, and we'll find solutions to all of these problems, but communication is key. More than anything is don't stop talking to your lender.
Joe, from your end, I mean, this may sound that I'm full of it, but I'm being dead serious. When in the 90s, when the stock market was going crazy and crazy things happened, I just didn't have the money to invest, so I stayed. Obviously, I mean, I wasn't even part of the game. It didn't really matter, right? Up to 2007 and 8, 2002, 3, 4, 5, 6, and 7, I wanted to buy properties, but every year properties were more and more and more expensive. That never made sense to me. I was just too scared. I stayed out of it. 2008 is the first time when I jumped into it, and everybody was losing their shirt, and all I could see was opportunity, right? Because I'm like, oh my God, right? And this time is the first time I was felt really, 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 really scared, right? Because I could not afford to lose $5,000 or $10,000. I just didn't have it to lose. This is the first time, and this is a conversation I've had with Rahul. I'm like, dude, listen, chill out, right? Everybody, all of us are in the same boat. And at least for the last 5, 6, 10 years, one thing I can say with certainty that we have been very, 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 very disciplined in how we've been investing, right? You drive a car, you drive at normal speeds, you're doing all the safest things. Guess what? Do accidents happen at that point? Do people get killed? Yes, that's statistic. But my belief is in real estate, if all you can do is do your best, and then the chips fall where they may. And if you've done all your best, in the end, you will end up in a very good position because this market will present opportunities. What do you say to that?
I agree. I absolutely agree that if you can keep yourself calm, stay focused, and look, you're going to find. I'm not going to say it's as good as the 9-10 type scenario, but there are going to be opportunities because, as Juan indicated, there are going to be other investors that got a little bit over their skis, that properties may end up coming back or may, need to be short sold or something like that to get out of them. And then whoever has that capital will have the ability to snatch them up in a very timely type scenario and get themselves in at the appropriate price point. And I'm really going to echo one thing that Juan ended with is the idea to communicate. It takes a village, it takes a network, it takes all kinds of people's response. When you hit a situation like we're about ready to enter into, and somebody actually asked me, another media source asked me on Friday where I thought we were in this thing, and I said, well, we've just introduced the starting lineups. I said we're not even at the first inning yet because we don't know. So once the virus clears up, then everybody will see how many people get to go back to work and what that impact is, and how many people get back on an airplane and go back to Disney World or wherever they're going. But the idea is to talk. Juan hit it on the head that people want to know your plan. Nobody wants the property back. Trust me. I don't make a loan with the idea that, wow, I hope I get that property back. Right. That is a very, very bad business strategy. What we want is we want the people to keep the property, but we need to know how they're going to keep it. Or if we do have to dispose of the property, we do it jointly. People do it together so that we can find a reasonable exit strategy. And that may include a phone call to the mastery group to say, I've got several properties that are about ready to come back. This is what they have into them. Does anybody have an interest? And those people that have the capital then will have the ability to pick those up. The person then exits and still has most of themselves intact, and the attorneys and everybody else aren't the ones that make the money, and everybody can move on. But communication is always key, both in finding the opportunity and resolving the issue.
No, very well said. And one last thing before we wrap up the call. A lot of times people don't understand how community banks lend, right? Can you talk about like that whole footprint thing? Because even I didn't know, man. I was in real estate for 15 years, since I was like 20 years old till about 32, 33, and I did not know this whole idea of the footprint. Can you explain that really quickly?
Well, sure. I mean, community banks, I kind of referenced it a little bit of an analogy that we have to stay to the rivers and the streams we know, so that we're looking at things from a geographical perspective. That I can tell you, our organization, we're a 2-bank holding company, and we've grown to actually some critical mass. But my philosophy is, if I can't get my lunch, eat it in the car, and get to that property, and then get back to my office, it might be too far away. Now, right. In the middle of the day in Chicago, I can get all the way up to Zion, I can get down to Kankakee. I can get out to DeKalb. So, I mean, it's a pretty decent footprint. But geographically, that's important to us because that's what we know best. When somebody says a block in the city of Chicago or they mention a town in the western suburbs, we know that town.
Right.
And then that way, if we know, hey, if we got to lean a little bit harder or we got to make sure the file's in tip-top shape, we know that based on the opportunities, not only where the property may be located, but the borrowers that we're dealing with.
Right. And with you guys, you truly have, and it's interesting because, and this is very rare, that, initially when we started doing business with Joe, he did 3, 4, 5 loans. And again, mind you, and Joe knows this, right? It's not perfect. Them as a bank, they were going through a lot of growth challenges. He was at a different bank, then he goes to a different bank, and he's like, man, I want to do loans, but he's trying to grow a bank, trying to get the mess resolved on his own end. And a lot of times our loans were stuck, right? A lot of times I'm like, man, this son of a gun Joe, man, I can't help it. But guys, guess what? Over time, these are relationships that have worked. And at times, he said he went up to 800,000 in loans, and he's like, well, my limit is full for right now. Maybe next year I'll do more loans, but here's sister bank that you should go to. And the sister bank did the same thing. They went up to 800,000, 900,000 in loans, and then they stopped. They're like, well, how about go back to Joe? And these are things that are going to happen to you. If you want to grow in real estate, these are long-term relationships. We need residential lenders, we need some of the hedge funds, and you need the small banks. There's no one solution, and that's what people do a lot of times. They're looking for one-trick pony, and there's no such thing in life, right? Joe, man, thank you so much. I really appreciate you joining. This has been kind of fun. This is conversation we've been having back and forth, so I wanted to kind of have everybody join in. Juan, as always, buddy, thank you very much. And
thank you.
So I promise, Juan, I will send you Joe's number. Just don't give it out to anybody.
Awesome. Yeah, no, if I can just, Andrew, say one more thing. Many times, I've stayed up late at night and say, man, that Andrew's a lucky guy that he was buying in, 2011, 2012 when people were giving properties away. And like, why didn't I get in when Andrew did, right? Because I was too dumb. I was doing my day job. I think this is that opportunity that we have all been looking for. And I really hate to say this,
No, I know because it's devastation for people, but you're 100% on the mark.
Right. And I think we're going to see, unfortunately, we're going to see a very different impact depending on socioeconomic class, right? There's not a commentary on anybody, but you're going to have a very different impact. There were already people who were at risk, right? The ones that were hanging on by a string that thought that they were going to be able to straighten themselves up and save their real estate. Well, this is just going to knock those people out of the game, right? So there's going to be definitely some buying opportunities. So we all need to keep our head on straight. This is the opportunity that we have been looking for, right? I think there's going to be some people that were strong, that they were, kind of that the middle class is going to get squeezed hard. Some people are going to come out stronger. Some people are going to fall to the wayside. But like anything, I think this is that very in our world we call it disparate impact, right? And we're going to have that there's the people that were already marginal are going to be hurt harder than those who that had financial resources to go through it. And for those that do, there's going to be some huge buying opportunities. So, I've always said this is a game of finance. As much as it's a game of real estate, it's a game of finance, and we've got to load up all our barrels and come out blasting when the time is right. So, thank you for your leadership.
I truly think, man, that a lot of people who, and it's not, I used to always think, right, there's this thing that, of course, people who have money make money, rich get richer. It's all true. That's a fact of the world. But guys, listen, all I have to say is one thing. If you cannot make it in America, please, for God's sake, don't go anywhere else, right? Because I'm just telling you, I mean, I am telling you, I'm a first generational immigrant, right? And 99.9% people who are on the webinar, there's hundreds and hundreds of people on that are part of Chicago Real. All of us are damn immigrants within the last 2 to 3 generations, 4 generations, right? And when you talk about opportunity, you can look at it from a standpoint, and some people will, oh my God, other people are losing money, Andrew, and then people are going to profit. Guys, listen, that is the way of the world. I didn't make it. It's just, it is what it is. You have to first basically make sure your own household is taken care of, and it has not much to actually do with how much money you have, but are you financially literate? And that's very different from having a lot of money. You don't necessarily need a lot of money, but this will create a ton of opportunity. The question is, do you understand how to take advantage of it? And are you willing to have the discipline because Americans are great at one thing. We forget any of the lessons. We forgot 2008. People bitch and moan about it, but we forgot it. Having said that, guys, we can talk about this forever. Joe, thank you. Mr. Juan, thank you so much.
Thank you.
And with me speaking so much, my buddy, Rahul, my business partner, he didn't even get a chance to say anything because I kept talking and talking and talking. So, Rahul, my sincere apologies. Guys, thank you so much and have a good day.
Stay safe. Thank you.
Thank you.